Okay, great. Okay, so personal example here. So some of you know my story, right? I went from being really broke in my early 20s to finally getting my act together, getting to college, getting a good job at Deloitte, and getting married. And so when I turned 30, I was planning on my first kid, my daughter. We were planning on having her. And I wanted to prepare to have a house for her, right? And I was in a fortunate situation because we worked hard and applied everything you've learned to date so far. It's a fortunate situation to have a couple $100,000 saved up for a down payment on a house. And it was a situation that I never thought that I would have been in, right? Like being completely broke earlier on. And I felt very blessed to be in that situation. But I wound up making a pretty bad decision in hindsight based on that decision because of some emotional things that happened when I found out that we had a kid on the way. So first off, we were trying to buy a house. This is early 2020, late 2019. Does anyone remember what happened in 2020? COVID. Yeah, exactly, COVID. So my wife and I were trying to save up some money for this house, and Bay Area is expensive, and single-family homes were all $1 million in the neighborhoods we wanted, so we decided to go buy a condo instead, a cheap condo in a kind of a worse neighborhood, and the idea was we're never going to be home, right? We're never going to be home. We'll be in this. We'll not stay at the small condo because we'll take the kid out and we'll go to all our friends' houses all the time. Don't worry about buying that small house, right? The small condo. We'll be okay because we're never home. Man, we were wrong, right? It was COVID. We were stuck in a house with an infant, and my wife was working in a hospital at the time, so we're always worried about disease in the small house. And we locked in that decision in December 2020, and we heard about COVID in like February 2020, December 2019, and I heard about COVID in February 2020, right? So just a couple months later, we instantly were like, man, no one could have predicted that was going to happen. So it was a pretty bad spot to be in. And then we just happened to have a very energetic kid. So the small place was not working out that well. So there's this, having a young kid, I was emotional at the time. I had quit my job at consulting and got a job at Google on the AI deals desk, so I was starting to make some good money. And it was a scary time to be a new dad. And it was a scary time to be in the market and finally have a little bit of money because the market was going up and down a lot, right? And so I was in a fortunate situation that when I joined Google, they gave me some of their stock. And a couple years into it, that stock was worth about $200,000. Again, for me, was an unprecedented amount of money. And I was in a situation where, do I pay off the condo? Like, should I pay off the condo now? And I decided to sell all that Google stock in the short term to pay off the condo. The condo had a 3% interest rate on it. And that 3% interest rate, this happened in 2022. I'll show you the math. So how much was my annual interest expense based on this condo? Anybody? 3% times 200,000? There you go. Yep, right. So I had $6,000 in annual interest expense. I felt so lucky to have this kind of cash. The market was in turmoil. The job was tough. Layoffs were happening at my company. And I decided I'm going to pay this off and sell my Google stock. Even though I know I was young, I was still in my early 30s, and there is a long time compounding. So like a lot of my friends were like, why not hold on to the stock and keep the mortgage? But I had a lot of people who had said, if you could pay off your house early, pay off the house early. But the interest rate's slow, so it was $6,000. I'm going to show you something, and this is depressing for me, but I'm going to show you why this is important for you all to see. And everything I'm teaching you actually is relevant and will impact your lives. Let's look at the time horizon. So these are all real numbers, real story. 2020 Google stock. When I sold, 2022 was when I sold it. It was about $100 a share. All right, so I was trying to save $6,000 a year in interest expense. It is about $100 a share. What's the price now of the shares? $300. Okay, so I sold the Google stock to save $6,000 a month. 3 years later, it's worth $300 a share. How much would my $200,000 have been worth? $600,000. Okay, so what was my gain on my shares? If I had held the shares, what would have been my gain? Forget about taxes. 600,000 minus 200,000 is? I'll drop this in a second, equals 400. Okay, and how many years of interest expense did I save? 3 years of interest expense. Right? What's 3 times 6? 18,000. Okay, this is opportunity cost. Right, we've talked about opportunity cost a lot in the class. Wasn't a bad decision. I paid off the house. I was blessed enough to be able to pay off the house. I was very, very thankful. We wound up selling the condo because it was too small anyways, and now we rent. We'll talk about the decision later on the rent versus buy and valuation theory. And this would have even been better if I didn't decide to buy the place and I decided to invest in the market. And we'll go over why that was the case as well. But you can see just from this decision alone, I could have made an extra $380,000 in my portfolio. I didn't. And I should have known better. I should have known better at the time. But I was emotional. I had a young kid. It was a tough time in the market. And the same things will happen to you when you ignore the laws that I'm trying to teach you in the class, the laws of finance. All right? So I'm trying to teach you everything that I'm relevant. This number is going to get worse every year I do this lecture, and it's going to be painful for me to do this. But I'm exposing this so you all can learn how important these techniques are. Because real wealth isn't earned. Real wealth is accumulated through investments over long time horizons. And that's what I'm going to try to show you and impart on you all today. Again, in a corporate finance text, this also matters, but I'm starting with personal finance, so it's relevant to you all. Okay. So another good example of this is Berkshire Hathaway. So Berkshire Hathaway in 1965 was worth $19. Right? This is a bit cherry picking of an example just to illustrate the point, but S&P 500, we could do something similar and it would still have a dramatic outcome. It was worth $19 in 1965. I looked at the share price in 2025, it was approximately $1 million. Right, so if there was this story I was reading about people who were finding out they had an old stock certificate in their safe from their grandparents who worked there, and now they were suddenly millionaires. All right, you would have had to save $16,667 every single year during that time horizon to make the same amount of money. And it's easy to go, well, that's Berkshire Hathaway, but it's not just Berkshire Hathaway. That's the power of compounding, of leaving money alone over long time horizons. So I'm going to show this in a more relatable example to all of you. Who read the book and read about Maya and Jordan? Some of you. The other ones, catch up on your reading. It's important. I think it's helpful to understand the context. I'm going to look at Maya and compare them to Jordan to show you the power of time when we're looking at compounding. And I want you to work along the examples with me. All right. So Maya is more like me, kind of more my style person. And I know both of them. I'm anonymizing them for you all. But these are real people that I know. She was an early starter. Parents didn't give her anything. At 18, she was kicked out of the house. She got a retail job at like Starbucks or H&M. You can think of one of those places. But she knew this kind of education, and she decided she was going to take a piece out of every month of paycheck and contribute to her retirement early on. At least her parents gave her that advice, and she followed it. She does it for 8 years. All right, she does it for 8 years, and then she stops at age 26 because she just gets frustrated. She's like, all my friends are doing better than me. They're spending on all this fun stuff. I've been hustling all this time. I'm just going to stop. And she leaves it alone until she's 42. Then we're going to talk about Jordan. All right, Jordan, opposite situation. Again, a friend I have, parents gave him money, let him stay home. He was pretty comfortable, went to a good college. Parents paid for the college. And he kind of slacked off a bit with his investments. Not too bad. He still starts at a good age, at 26. But he kind of liked living luxuriously. Like I knew him, and he was this guy who, he moved up to the Bay Area after he graduated college, and he wanted to live in a nice apartment in Menlo Park, even though it was like 70% of his income, because he liked it, right? Like it was fun for him. He liked going on big trips. He liked having a nice car. And he would always tell me, like, Devin, you're stupid for investing. You don't invest. You got to enjoy your life. 26, he realizes, hey, I don't have any investments. I should probably catch up. And he's going to invest for 15 years while Maya invests for 8 years. So he's going to invest more for longer. Who do you think will be richer at 42? Anyone have any guesses? Maya, but it's counterintuitive, right? So let's prove it out how much richer Maya will be based on these facts and circumstances. So we're going to take, first, let's do Maya. We're going to be 2 steps to calculating Maya's future value. We're using 10% as the historic market return. We're not going to consider inflation or dividend returns or anything. We're just going to use a 10% historic average. 10 is your IY. You can just put 10. You don't need the percent there. How many years is she investing? 8. And then is she investing all at one time, a lump sum, or is she investing an annuity? Annuity, and we're going to assume at the end of every year, so that's called an ordinary annuity. And so ordinary annuity of, what's 470 times 12? Anybody? 5,640. Okay, 5,640. And what are we solving for? Present value or future value? Yeah, future value. We want to know how much she's going to be worth if she put $5,640 in every single year, at the end of every year, at the end of these 8 years. So how do we do this in our financial calculators? Let's throw it up on the screen. All right, 8N, 10 IY. What do we have? 5,640. We'll make that negative because it's a cash outflow. She's making an investment payment. And then we figure out the future value. We'll roll round, but what do you all get this calculation? Everyone's be able to do this on their calculators. If not, raise your hand and we'll go through it again. You need to be following along. Yeah, we'll go through it one more time. Again, 8N. That's 8 years. 10 IY, your annualized interest. 5,640. Negative here. That's your payment. That's your annuity. And then your future value. You just press future value. You able to get it this time?
Yeah.
Great. Okay, 65,000 is our future value. Okay, 65,000 our future value. We're all agreed. So what does that mean? At 8 years, from 18 to 26, at 26, how much does she have approximately? 65,000. So we can understand why she's frustrated, right? She's been saving money for a while. She's has a good amount of money. That's still a meaningful amount, but it's not life-changing. So she gives up. But what happens? She leaves that money in this S&P 500 index fund. And how long does she leave it there? Well, we're going to look at the calculation at 42. So what's 42 minus 26? How many years does she leave it alone? 42 minus 26 is what? 16 years. So we need to go one step further. N equals 16. There's no payment now. IY is going to stay the same. What's our present value now? It's our old future value, the 65,000 outflow. And we're going to solve for future value. You all following?
Yep.
OK, let's do that. I'll do 65,000 present value, 10 IY. How many years? 16 years? That doesn't seem right. 16 years doesn't seem right, guys. You guys give me the right math. 14 years, right? 14 years. Okay, 14 years. We'll do it again. 14 N, 10 IY. Present value 65,000. Okay, what's our future value? $246,000. Is my doing all right now? That's a lot of money to have in your 40s, right? That's not a small, inconsequential amount of money, right? So we'll summarize that. Well, let's say it's $250,000, all right? Just for rounding. So Maya has about $250,000 in her 40s. That's pretty nice, all right? Let's look at Jordan now. Let's catch up with Jordan. So Jordan starts a little later. Jordan is now, how long is he investing for? 15 years. What's his investment? What's 500 times 12? 500 times 12. Everyone do the math with me. 500 times 12. 6,000, right? 6,000. Same yield on your investment. Your present value, we don't have any, no initial investment. Future value, we're going to calculate. So 15 and 6,000 payment. 10 IY. Did I get the right number? 14N, sorry. 15N. 15. Let me make sure I did it right. 15N, 10 IY, 6,000 payment. Is that what you all get? So about 190,000. We'll round it. Who's richer? Maya. Who saved more? Who actually saved more money over the time? Jordan contributed $96,000 over his time horizon. $96,000, right? How much did Maya contribute? $45,000. Maya contributed less than half of what he did. How long did Jordan do it for? 15 years. Maya did it for 8, almost half. Who's richer? Maya. Why? Why is Maya richer? Exactly. She started earlier. So first big takeaway for all of you when you're taking this finance class, why does this apply to you even if you're not in finance? It matters more than probably any of your other classes, right? If you start now, any of you start now, that's going to have a huge financial impact on your later life. All right, so make sure if you're investing, the earlier you start, the better. She just started earlier. Even though she had less and had less time to invest, she started earlier. Let's look at what that means for retirement. All right, so Maya ended with 250,000. Let's make that the new present value. And she's in her 40s. What's a good retirement age for Maya? Maybe 62? Is that good? Still pretty young to retire, right? It's not a bad time. So we'll give her 20 more years for that to compound. She never saves another day in her life. 10 IY. Now Maya has almost 2 million bucks. Right, Jordan's going to have less. We all see the power of this? Can everyone do these calculations?
Just confirming, PMT is negative because it's the money you're using to invest, right?
Yeah, so when we're looking at cash flows, outflows are always going to be negative. So if you're taking the money and you're investing it, I know it's complicated because you're investing in yourself. You still own those assets. You can think if you're investing it, that's your outflow. And then when you have access to it, it's your inflow. That's when it's positive. Good question. Any other questions? We're all able to get these numbers. So we can see, just by Maya doing this for 8 years, she sets herself up for a comfortable retirement for the rest of her life. Right, so starting early, if you all could start early, that's going to have a huge impact to you all. So Maya contributes half, has double the wealth because of the power of N and IY. So any of you, while you're going through all of this, think of it through these levers. How long is your biggest lever to impacting how much wealth a business or how much value a business or a person will accumulate over time? You start earlier, and we're going to use some big numbers soon. Start earlier, and unfathomable things become imaginable just by using time. How much is the next piece? Higher savings rates earlier, and when, we're going to have a bigger impact. If you invest on day one, it's going to have a much bigger impact on your last day, which has no time for compounding. And lastly, we have our rate of return. And we're going to have a whole class on rate of return and risk and reward and the trade-offs. But for this section, we're just going to talk about 10% average yields because that's the historical return of the marketplace. And then we're going to talk a little bit about inflation today and interest rates, just so you have a baseline. But we're going to get more into risk and return. But that's less in your control. And you have to take on risk to get greater return. So we're going to use some cooler numbers now. Let's imagine you want to retire. How many people in this class want to retire and have $1 million in retirement? You'd be like, I'm pretty happy with $1 million. I'm even happy with $1 million. That's a lot of money. $1 million is a lot of money, right? How about who wants 10 million? Okay, we got our higher achievers here. What are you doing with the 10 million? You driving some nice cars or something, going on first class flights. What about 100 million? Who's aiming for the 100 million? Mambabiola, I like it. Good job. Okay, we got a few 100 million years. If we look at just what it would take if you're going to spend 30 years to accumulate this amount of wealth without investing, we can see how challenging this might be. So $33,000 a year, we're assuming that they're just keeping this under the pillow or in a checkings account, no interest, all right? $33,000 a year savings to get to $1 million if you don't invest. That's a lot of money, okay? For anybody, that's like your maximum 401k contribution limits. Beyond that, for After tax, that's going to be a good chunk even if you're making 100,000 a year. That's really hard to do. You can see the 10 million becomes nearly impossible. You'd have to save a top 2%, top 1% income, all of it, in order to get 10 million. 100 million, 3 million a year. It's not going to happen through earnings alone. You can't earn your way to $100 million unless you're like Brad Pitt or something, right? You're like some rock star, movie star, and even them, they're going to really have challenges doing that, right? You can through, we'll talk about business valuation and business exits. That's another potential, but that's also just another style of investing that we're going to talk about through this class. But what if we were to try to look at that from a lens of investing? And so this is where the rate of return has a larger impact. If we were to look at it at $33,000 a year, but instead we're going to invest those returns, we can play around with it. So 33,000 payment, 30 years. So we're maxing out our 401k or retirement, 401k or retirement accounts, 10 IY. If you invest that money instead of having $1 million at the end, you get 5.5 million, 5.4 million in 30 years. Take in mind, that's an early retirement. If you start in 25, start your career and can do this, that means at 55 you're halfway to a decamillionaire. It's a pretty big deal, right? For a $33,000 investment. I know it seems high, but that's a huge return on your life. You're going to be in the top 1% of net worth for people, or in the top 5% for families probably. Okay, if you only keep it in a checkings account or a savings account that's getting a 4% return, you'll see a drastically different outcome. Only about 1.85 million. And we'll talk more about risk and reward, but you can see just by escalating our risk in investments can have a huge disproportionate impact on our future outcomes. Similar to my situation, right? In the last 3 years, I lost out on almost $400,000 because of this logic, right? I took a 4% return instead of a 10 or 20% annualized return for the risk. Does it make sense? Yes, Jacob.
It's kind of like a question of like when you're at the age of retirement, would you then sell all of this at once when you're ready to retire, or would you just like sell it as you gradually need it?
Okay, so question was, what's the retirement strategy for pulling this money out at that point in time, right? We're going to talk about that. That's coming up on the future slides. So it's a good question. I'll hold off. But there's a few things we'll consider today. Perpetuity math, annuity math, and sequence of return risk. We're going to try to cover all that today if we have time. It's a good question, so hold on to it, all right? Other ways to do this is, that's annuity math. What if we were to do lump sum math? So lump sum time value of money means we're discounting that future value. And instead, we're going to find a rich uncle or aunt who's going to give us the gift today. Or we're going to hustle really hard this year to save up that money and then put that all in our retirement. This is also known as coast-fi or coast retirement. You just try to work really hard to get a lump sum into your account and let it grow over time. What does that look like? If I want $1 million in 30 years, 30 and do this along with me, at a 10% return, we need a $57,000 investment today. All right, so if you're able to hustle really hard 1 year, stock away all the money for 1 year, you never need to save for retirement again if your $1 million retirement is your goal. Right, and again, this is caveated with volatility risk and whatnot, but still, isn't that amazing? That's a huge impact if you're able to hustle and just work really hard for 1 year, and then you don't have to worry about saving for retirement if that's your retirement goal. Now, let's take this one step further. Here's a game I'd like to play with you all. Name some billionaires you know personally. No, you don't have to know them personally. If you do, introduce me. But name some billionaires, just public billionaires that you're aware of. I want to hear a few examples. And just shout them out. Jensen Huang. Okay, so that's NVIDIA's CEO. Who else? Bezos. That's in every class, man. Bezos has been the most popular so far. Who else? I want 5. Come on, guys.
Arnold Schwarzenegger.
Oh, I wonder, is Arnold Schwarzenegger a billionaire?
Yeah, he is.
Oh, yeah, that's pretty cool. I didn't know that. That's a new one. Thanks for the curveball. Who else? Elon Musk. All right, and then let's do a 5th one. Who's a 5th famous one? No, we don't know any other billionaires? I'll say Bill Gates or Warren Buffett tend to be the common other ones that come up, right? Bill Gates or Warren Buffett. Do we know a common theme? Do we have a common theme with all of these people other than them being old white guys? What's a common theme? There's one thing. Let's ignore the gender and the race for a minute. What's a common theme there? Age. I think none of them, maybe Elon, how old's Elon? Maybe in his late 40s. None of them are young. The billionaires, the people who have hundreds of millions of dollars, most of them accumulated their wealth in their late 40s or post that. Many of them also had early starts, meaning their family gave them something to start off with. All right? And that's a tough reality, but it's not something that you have to work against. It's something that can work for you by changing out your time horizon, which is tough when you're young. It was tough for me when I was young. Like, someone breaks up with you and then your world's over and you're never going to, like, I remember never thinking I'm going to get married after a breakup, and then you're only 21, right? It's like you have your whole life ahead of you. I heard someone else in my other class today being like, oh, I had the roughest week ever, my life's over. It's like, you're 21, it's okay, there's a lot of life left to live. Your time horizon, as you live more life, you're gonna realize that time moves faster than you'd expect and that you can tolerate longer durations of time. And you don't have to play the game with just your own retirement, even though 50 years would all be within your own retirement age. You could play the game multi-generation. Many of the people that I've known, successful, very wealthy CEOs and CFOs that I've worked with in my career, have trusts, either given to them or trusts given to their kids, where they're planning out multi-generation. Like, I'm gonna give a $100,000 gift to my unborn grandchild that they'll get access to when they're 30 or 40. So they have many, many years of compounding to build up that trust so that they're succeeded for their retirement. So you can play these games on, I'll fund someone's future retirement, an unborn person's future retirement, and you can imagine how compounding can work in your favor. So I'll use an example here. If you have a goal of hitting $100 million, which is, we can agree that's an obscene amount of money. That's a lot of money, right? If any of you have that, please talk to me. I need more friends. All right. 10 interest. We'll do 50 years. That's $850,000 today. All right? Now, that's still a lot of money, but this becomes manageable if you think about the retirement games we played. We taught you how to get to 5 million. If you don't need that money in your retirement, you can carve that out, give it to your grandkid, and your family now has a chance at multi-generational wealth. And that's what many people actually do. Benjamin Franklin was famous for this, for setting up, I think it was the University of Pennsylvania, someone can correct me if I'm wrong, setting up their entire endowment by doing something like this, putting up a small initial endowment and then setting it up that they'd access it after 100 years of compounding. And it's become like their largest endowment, right? The power of compounding is a wonder of the world. We could even go further and say, what if it was 70 years? $100 million. 100,000 bucks. That's a much more manageable amount of money. Do we all see? I know it's hard for you to think out 70 years, but if you have the ability through this class to plan that far ahead, you can start having a drastic impact, not just on your life, but the generations of lives that happen after you, right? And if you're not thinking about kids, I know I talk about kids. I have a friend who really loves cats. They're a decamillionaire, and they have a trust set up for a cat shelter, an animal shelter. I regularly tell them, like, hey, maybe we could classify my daughter as a cat or some way that she could get some access to that. But no, that's all good. You could do it for any type of generosity to set up your future, right? So it doesn't have to be just if you want kids or thinking multiple generations, but you can have an impact for many generations if that's the way you're thinking. Now we're going back to your question over here. So my main goal of that was to show you the power of time can let all your dreams come true if you just let it. If you just let it, right? All right. And now, how do you use the money once you want to access it? Again, this is all going to go into business valuation soon, but I'm just doing this because it's a little more relatable for you all to understand time value of money. There's a concept called perpetuity and annuity. What's a perpetuity? Can anyone explain? Well said. You're only taking out your gains. The idea is that you'd want to be able to do a fixed amount forever. That's perpetuity. Annuity is you're drawing out, and after a certain time horizon, you run out of money. If you're having trouble remembering that, for some of you, those are technical terms. Perpetuity, I like to think of it as perpetuity, I'm leaving something to my kids, right? I'm leaving something for the next generation. Annuity, screw the next generation. It's all for me, right? We're taking all the money for myself. Okay, let's look at how that would be different for different maths. So something we're going to teach about a few times in this class, the perpetuity and annuity. Perp and annuity is the 4% rule. Most markets and most market history, if you withdraw 4%, that's known as a safe withdrawal rate, from your portfolio, your principal balance will remain over time horizon, over any multiple periods of historical time horizons when you backtest. What does that mean? That means, and it makes sense, like what's our interest rates today, like between 3 and 4%? You could draw 4% forever against an account, and you'll always keep the principal balance. So that's called the rule of 4%. It changes over time, but the idea here would be if you have $5 million, you have a 4% rate, how much could you pull out? You could pull out $200,000 a year. And so 5 million, you made 4%, you pull out 200,000 at the end of the year, you still have 5 million. You can do that forever. Again, we're ignoring inflation here, but there's some inflation considerations there as well. Well, what if we didn't want to die with $5 million? Because you can't take it with you. You want to use it all. We use annuity math. So let's say someone's 65, they want to live to 95. I know that's dark, but you got to choose your death date to do this stuff right. So 5 million present value, we're going to say they're 65, they're going to live till 95. IY is going to say the 10%. And we are going to calculate out now payment. We're going to calculate the fixed income you can draw down in order to live off of that amount the rest of your life. So again, 5 million is your present value. 10 IY, 30 N. Payment. Oh, is that right? Let me do that again. Did I do something wrong? Seems high. 30 N, 10 IY, 5 million. Present value. Okay, 530,000 a year. Okay, so you get to live a much more luxurious lifestyle over this time horizon. We all get the same number? You get to pull an extra $230,000 a year. At the end of that first year, this goes down. Oh, it's because I did a 10% IY. So we did a higher return rate here, so they can live off more. Let me change this to 4%, so we're on equal terms, so you can see. So we'll assume they'll just do the savings accounts. Generally, Jacob, this goes to your question earlier. Generally, when you hit retirement age, you are going to start diversifying away from high-risk investments. Again, we'll talk about risk and reward later, like the S&P 500 or stocks. And you're going to go more towards CDs and bonds that are going to give you a steady return, which means your total return is going to drop. And we'll explain that in sequence of return risk eventually. So, 4%. Here we go. 30 years. 5 million present value. That sounds more right. 289,000. And $150. So you get about an extra $90,000 a year to spend at a 4% return rate. So that you can see how the return rates have drastic changes on your modeling. What does this mean? At the end of year one, this would reduce about $89,000. And now you have a smaller base that would grow. Eventually, that's going to hit zero by the end of the 30 years. Any questions so far? Yes?
I'm kind of curious how you got the 200,000 on perpetuity. So it's 5 million divided by 4%, right?
Times 4%. Multiplied by 4%. Got it? Any other questions? So you get a little more this way, but you don't leave anything at the end. All right? Cool. Last major piece to talk through here is inflation. When we're talking through inflation, we haven't built that into our returns rate yet. So we've been talking what's known as nominal returns. Nominal returns means we're not considering inflation. Story I like to say is like my parents-in-law, my family-in-law, my wife's parents, we go to this pho place that was around when they first moved here before before my wife was born, right? So this is like 40 years ago. The pho place used to sell bowls of pho for $4. Now they're cost $20 for the same bowl of pho. They always complain. They're like, we never understand why you go here. Only a good deal is $4 for the bowl of pho. We're like, come on, guys, that's everything costs $20 now for a bowl of pho, right? Like that's a reasonable price to all of us, $15 to $20. What is that? That's inflation. They are looking at their money in present value terms back then. We look at our money in present value now. What does that mean? Your kids one day or the next generation, 30, 40 years from now, that bowl of pho is probably going to be $50 to $100. It's going to be very hard for us to imagine what that feels like at that point in time until that happens. But for them, it's just going to be the regular amount of money, right? So how do we adjust for that? Well, what you do is if you take inflation out of our return rates, so when we're using 10%, you take it to 8%, you reduce it by 2%. Or if you're looking at 4%, you reduce it by 2%. You're going to understand what that would feel like in today's dollars. Okay, that's what doing a real adjusted return is going to show you what that purchasing power will feel like. It's not going to be exact. We have periods where higher inflation and lower inflation. We've been in a period of higher inflation for a while. And certain assets and certain costs change over time. Like housing's inflated more, education's inflated more. Food has actually been really low inflation over the last 15, 20 years. So things change over time, but it's just a general convention we take to make sure that we understand the math that we're using and playing on more fair terms. Does that make sense? Any question on real versus inflation? Inflation versus nominal, real versus nominal? So on a test question, I might ask you what a real return is, but I will always give you the inflation rate if I do that. All right? All right. So this is for all of you personally before we get into more technical topics. Early mistakes cost fortunes. I hope you learned from my mistake of I should have kept the money in the market, even though it was a good decision to pay off the house. There was much better decisions to make. Time beats effort. So many of you will work the rest of your lives and then wonder why you're not as rich as a friend who didn't. We talked about Maya and Jordan, right? So if you invest early, that's going to have a disproportionate impact over a long time horizon. If you're making a decision, work backwards on how that's going to impact your life. Like if you're ever thinking of right now, if this was a personal finance class, I'd ask you all to make a decision on if you invested today versus waited 5 years to start investing, what would that look like? Start playing with those numbers so you can understand the impact they're going to have on your future. And then know what your goals are at the end, like having a perpetuity versus an annuity, figuring out what age you want to retire, figuring out what kind of life you want to live. It's all very important. We baseline that in other classes. And then I have an exercise here. We won't do it here, but it's just a helpful exercise if you want to do it yourself. Now we're going to go into more technical topics. Is there any questions on the more soft conceptual topics? In the exam, I'll just be going over present value, future value, annuities. You'll have to do problems like we did on the board on the exam for multiple choice or for fill in the blank. All right? Okay, next. We talked through this. There's a few technical nuances you need to understand as a finance professional. So far, we've only been talking about annuity dues. Ordinary annuities. I'm going to use an example up here. Okay. Ordinary annuities. We think about it this way. I like these little boxes when we're doing years. 1, 2, 3, 4, 5 years. I'm going to look at investing $30,000 a year. What have we been doing in this class so far? We're taking that 30 and we're saying we're contributing those or looking at them at the end of each year. You following? When we're saying an ordinary annuity, we're saying it happening at the end of each year. What does that mean for this cash flow? When we're using an ordinary annuity, how many compounding periods does this cash flow get? Annual compounding periods. We just count. How many? 1, 2, 4. That's different, right? Many students mess this up. In ordinary annuity, your first cash flow only gets 4 years. In a 5-year time horizon, it only compounds 4 times. It's funky, right? That's an ordinary annuity. How many does your last cash flow get? How many does your last cash flow get? How many compounding periods?
4, 3,
0.
0. Thank you. Who said 0? Good job. 0. You get it on the day that you're doing your analysis. This is your present day. All right? So you always want to think about in compounding periods. We're discounting these flows or looking at the future value or present value of these flows based off of the amount of time periods left. Okay, that's an ordinary annuity. An annuity due is a little different. Annuity due, we assume they're happening at the beginning. Still 5 cash flows, right? But they happen in the beginning. How much does cash flow 1? How many periods does it get? 1, 2, 3, 4, 5. Which balance will be bigger? Annuity due or ordinary annuity? Annuity due, because you have more compounding periods associated with it. All right. I want you to start thinking in these terms. I use the calculator so you can get comfortable and familiar with the terms. I want you to start thinking of these terms because cash flows will start to differ in future sections when we talk about capital budgeting, where you aren't always going to have annuities. Sometimes you'll have payments that go like 30, 10, 15, 20. And you're going to have to understand the timing of those cash payments. Is it today, at the beginning of the year, or at the end of the year? Also, in other classes, not this class, we don't necessarily compound annually. Like if you're saving for retirement out of your 401k, you're generally going to be doing that each paycheck. That's normally twice a month. So there's ways to compound within these periods, and the periods monthly, weekly, daily. But the general rule is the earlier the compounding happens, the more time or impact you'll have over those periods. All right. There's other concepts of why it might be better to diversify over time, which is called dollar cost averaging, which we'll go through that eventually. But we're not going to cover that in this section. All right. So there are some advantages to investing over time rather than investing at a point in time, but they're mainly risk diversification strategies. In the workbook, there are the case studies with answer sheets. There are your Google Sheet examples. So make sure you use those if you want to learn the Google Sheets or the Excel versions of the spreadsheet functions. So again, we've already talked about this. Lump sum investing, that's investing at a point in time, either in the future, looking at the future and discounting it today, or looking at today and extrapolating into the future. That's called lump sum investing. And then we can reverse that. We've talked through that. Ordinary annuities, looking at a fixed value over time, so making it a fixed payment annually or monthly or whatever it is. In this class, it'll always be ordinary annuities annually. We're talking about annuity dues. And we've talked about inflation. There's 2 more topics. I see you all. This is pretty technical. A lot of you are starting to look a little dry on this one. I know, so I'm not going to go the full section today. We'll stop by 11:30. But I have 2 more important topics, so please stay with me because these are both impactful to you. First is the concept of interest rates and how they're established. If I had a full day to cover this, I would. I think it's extremely important for you to understand. But when we're looking at rates of return, it's important to understand how interest rates are established. Does anyone here know the governing body used to establish interest rates in the U.S. government? Who said it? What is it? Well said. Federal Reserve. The Federal Reserve helps establish interest rates in our country. What are the 2 mandates of the Federal Reserve? They have 2 mandates. Does anyone know? It's important. This dictates the cost of money in your life and dictates inflation. They have 2 concepts. One is to stabilize inflation. I believe it's at around a 2% rate. Now, first off, pause there for a second. That's a little weird. We have a government agency that's trying to dictate that things should get more expensive over time. Economically, why do we do that? Your economics should have covered this. If not, why do they do that? So you spend money. They don't want you to accumulate wealth over time. They want you to spend money. It's a consumption-based economy. All right? It's a little funky, so recognize that's not in your best interest necessarily. The second thing that they try to do is full employment, to minimize unemployment. Now, you can look at that as a benefit. Like, yeah, of course, everyone wants jobs. But you can also look at it as the job of this entity is to make the people in America as productive as possible, right? They want to increase the cost of goods, so you have to keep working, and they want to keep you working. That might not necessarily be aligned with you. You might not want full employment your whole life, right? You might want to get retired eventually. So you need to be aware of this. How do they establish the interest rates that are paid, and how does that impact the economic goals that the government has? Well, there's a few things, and it's important to know this because this is how we establish the cost of mortgages and loans and everything else in our economy. So first, we have the risk-free rate. This is a concept of what would it be like if I had a rate an asset that I could buy that would pay a return that had no risk associated with it. So it'd be like, hey, I'm going to lend you $100 and I'm going to give a guaranteed return next year. I still have an opportunity cost associated with that return. I could have invested in something else, even if there's zero risk. So that opportunity cost is our risk-free rate of return at the most guaranteed rate that we're going to get it back. There's no risk associated with it. So if you think about this in government, that's like government bonds. Even though there's some risk with government bonds, like the US government might default, the US government might get attacked. So there's some risk there. There's other ways, like called tips and other things that have lower risk, but we won't talk about that. So just know that there's a cost of everything, even if there's no risk. Then we have an inflation premium. If I lend money to you, I want my opportunity cost, my baseline opportunity cost for no risk, plus I want to not lose value of my money over time from inflation. Fair, right? So that should be my interest. Default risk, there's a risk that you don't pay me. If you have a bad credit score, your interest goes up, right? That's what it is. If you don't pay me, there's a risk I'm taking on. I should be compensated for that. All of that is helped establish by the Federal Reserve. They help establish that rate in the Fed rate. Then we add on to it concepts like liquidity risk, my ability to use that capital or to sell that loan, and the maturity risk. If I give you a 30-year loan, it's a long time where interest rates might go down, up or down, and the market might change, that I need to be compensated for that risk. Those 5 components make up your interest rate when you're looking at buying a house or buying a mortgage or anything. So it's important to know these, and so on the test, I might just ask you, what is an interest rate if I give you variables to all of these? And I might throw some misnomers on it. Okay, the examples are on your workbooks. But you need to understand as an educated citizen how these are established and how the federal government influences these decisions. Now, why might the federal government want higher inflation rates or higher interest rates? If I increase interest, what happens? Things get more expensive. I buy a house, it costs 10% interest. I'm paying $1 million home or $1 million loan. I'm paying $100,000 in interest compared to a 3%. I'm only paying $30,000. Right? It's much more expensive. So what does that do? It slows down consumption, which decreases inflation. All right, so that's the idea there, is like, hey, when COVID happened, what did they do? First, the economy stopped. So what do? They dropped interest rates to next to zero. Why did they do that? So people borrow money and spend money. That was great, right? Like everyone got free money. Well, not so much, because what happened a year or two afterwards? Hyperinflation. We had a bunch of inflation, right? Why did that inflation happen? Because they dropped the interest rates. They knew that was a consequence of dropping the interest rates. How did they manage the inflation when it was up too high? They rose the interest rates. So everything got more expensive, so people bought stuff less. But what happens when they raise the interest rates? What happens to the job market? Jobs go down because companies no longer borrow to hire people. When jobs go down, it affects the prices of things again, and they have to change the interest rates. So the interest rates are like a fundamental aspect of the economy and the job market. And so understanding when interest rates are going up or down and why Trump or the administration is so impactful, like so honed in on interest rates all the time is because it has such an impact on the economy and how our purchasing behavior. All right? I remember COVID, you could get a 0% interest loan for cars. You can't do that anymore, right? People bought a lot of cars when it was 0% interest. Any question on interest rates? This is a fun little rule, the rule of 72. If you're having trouble with your financial calculator, if you ever want to figure out how fast money will double, you just take 72 divided by your interest rate, and you'll get your doubling rate. So that's just a helpful hack for whenever you're trying to do your exams or figure out math in your head. Let's see. The last piece I want to talk about is sequence of return risk. Because at this point in time, a lot of you have seen how powerful compounding is. Right? Can we all agree compounding is a real way to generate wealth other than maybe getting lucky with investments or business assets, right? Yeah. Compounding, that's how most people get really wealthy. All right? But there's a risk there. We've been looking at 10% averages, 10% average returns. We know that the market, I'll pull it up. We'll do 5 years. The market doesn't just go up. There's lots of down troughs. Like 6,000 to 10% decreases here. There's huge times. And during COVID, what was it? It went, what's this, COVID here? COVID, it went down like 50% or 40%. There's huge down troughs. So it's obviously not 10% at any given point in time. 10% is the average historical return. So what happens in real life when you make investment decisions? Well, this is called your sequence of returns. So I'm going to look at two people that have average 10% returns that have drastically different outcomes over a 3-year time horizon. So this goes back to your question earlier about how do we manage sequence of return risk, or how do we look at retirement. We'll look at, give me a boy's name. Ryan, and a girl's name.
Kelly.
Okay, cool. Ryan and Kelly, thank you. Both are going to start with $5 million. And they're 65, they're retired, they're going to retire for 30 years. Both of them are going to go in the same markets. Kelly's going to start 1 year later. All right? Plus 1 year. 20% downturn is the first year. 30% upturn is the next year. 40% downturn is the year after that. All right? Both of them start with the same amount of money. Ryan's going to start here. Kelly's going to start here. So Ryan starts in a, and this is counterintuitive to most of you. All right? This would be like Ryan is starting here at the top of this little market, and Kelly's starting at the bottom. When I ask most people, when you retire, would you rather be at the top of a market or the bottom of a market? Most of you are going to say top. That's a wrong answer. You don't want to be at the top of the market when you retire. You want to be in the bottom of the market. Most of the time throughout your investing career, you want to be in the bottom of the market. You want the top of the market to be later in your retirement, always. So whenever things are bad right now, that's good for you all because you have a lot of time. Buy things when they're low. Buy things when it's bad. I'll give you an example here. And you see it all the time. I see it all the time where like people start bragging about, I'm retiring early when the market's at all-time highs. That happened during COVID a lot. A lot of people did this like, I'm retiring early. All those people are back at work. All those people I knew that said that are back at work because they retired when the market was very high, and then when the market dropped, they got surprised by how little they actually had. So I'll walk through what that means. Ryan starts $5 million. He's at the top of the market. It goes down. What happens to Ryan's $5 million? What's at the end of the year? Assume he's not taking out any money. How much money does Ryan have? What's 80% of 4 million? 5 million. You all following along? What is it? What? Yeah, 4. Ryan lost $1 million. That's a rough year for Ryan in retirement, right? Kelly hasn't retired yet, so she still has her $5 million. Now the market goes up 30%. How much does Ryan have? 5. So he's kind of back where he started. What does Kelly have? Okay, now they have a really bad market. What happens? 40% decline. How much does Ryan have? What? Louder? Okay. So about $3 million bucks. That seems right. $2 million decrease. How much does Kelly have? Anybody? What? 3.9. And not checking the math here. We can see they start with the same thing. If they have a bad year in the first year, after the retirement, so they started at the top, they went down, they're going to be in a much worse position. He's almost $1 million poorer than Kelly. And it has nothing to do with his drawout. It's just by the time that he retired. So generally when people ask me about retirement and ages, I tell them, like many people are like, I want to retire at 65. My advice to them, and same thing with businesses, is you don't want to retire at 65. You want to retire in your 60s. You want to sell your business in your 60s or when it's been around for 20 years. Because you want to time the market a bit there. If the market's been bad for a while, then maybe it's okay because the market will likely go up over time. If you're in a very hot market and it's been a hot market for 3 or 4 years, maybe hold on and make sure that you do some stress tests. What happens if the market drops 20%? What's that going to happen to your net worth? Right? So it's counterintuitive, but generally, when markets are good, that's the time to work harder. When markets are bad, that's the time that you can actually enjoy your accumulation. It's counterintuitive, but that's why I teach this class. If it was intuitive, then you wouldn't need the class, right? Okay, let's do it one more year so you can see. Let's see, so 30, 40, 50% gain here. Can someone do it? And then we'll take the average here. We'll see that the average here is, 10% annualized probably? 30, that's negative 10, yeah, or 40. So we'll do 40% here, sorry. We'll do a 40% increase again. What does this get to? What? What's 1.4 times 3.12? Someone give me the math. What? 4.368? Okay. And then how about this one? 3.9 times 1.4? Anybody? Make sure you can do the math. Does everyone get 5460? Another important lesson here. It's an elevator down, it's a staircase up. All right? They went 40% down from the 6.5 million, then he went back to 40%. Right? This is a 10% annualized return annually over the 3 years. I could show you a lot of different 10% annualized returns that have drastically different outcomes depending on what time the declines and inclines happened. Okay, but you can see they have $1 million difference from this, and then Kelly doesn't get back up to 6.5 million even though the return stabilized because she had the drop. It's an elevator down, a staircase up. All right, so even though we're talking about annualized returns throughout this class, it's just important to realize that there's a sequence of return risks. So what's this called? Sequence of return. All right, can you all remember that? Okay. Let's see. So again, with the class, make sure we've already gone through, this is a section of clarifying goals. Like we've already talked about where you are now as accounting, understanding your budgeting, your basics, understanding financial statement analysis and ratio analysis. Then we're moving now to setting goals. And so once you've set your goals using the Marx framework, you work backwards after you've chosen your assumptions to make sure that your plan of action is going to meet that goal. And this is a very helpful tool to make sure that you meet the goals in your life. All right. So are there any questions about the lecture today? Now, this is a lot. I normally would go over workbook problems, but I don't want to kill all your brains after so much math. But any questions about the content today? Was that helpful? Interesting? All right. So for next class, please work on your workbooks and the case studies. We're going to practice this in detail. It's going to ramp quickly because the next lecture is going to be going over valuation theory, how this applies to stocks, bonds, and businesses. All right? Okay, I appreciate you all. You all have an excellent day. Thanks for being in class. Bye-bye.